Hello, Abel. Can you hear me?
Yep, I can hear you. Good morning.
Excellent. Thank you. Just testing. All right. Well, I think we've got 12:30. So welcome everyone to class this week. We are getting close to the end of this very fast 7 weeks. So glad to see all of you here. We've got most everybody. I might have a couple more join us. So everybody can hear okay and everything. I tested it before most of you got in here, and I was told I could be heard. So just to review where we are, this week we're going to talk about chapter 5 in our textbook and do the homework for chapter 5. You should all have your grade for your the midterm exam. It's all been corrected, and if the feedback should be in the feedback box in the Dropbox, so you should be able to see what I mentioned to you in terms of things that may have been incorrect on that. If you have questions about that, please send me a message or ask that probably outside of class time, but anytime, other time that you'd like. So overall, the average was pretty good, and I was pleased with how that turned out. So now, before we go too far, I will tell you that the final, which will be actually starting in a couple, just really at the end of next week, you'll have an opportunity if you want to get into it. It will not be like the midterm in that it will be a quiz in Brightspace. It will be a timed exam for 2 hours, and it will have 50 multiple choice. Well, I shouldn't say that. It will have 40 multiple choice and one essay question, if you will. That will be the how that will work. It will be fed to you like on the quizzes section in Brightspace or Desire to Learn. So that you will be able to take it anytime for a whole week, but once you start it, you will have 2 hours to complete it. Okay, so you'll want to pick your choice, your time carefully. So just so you know what to be expecting, I think that we'll do a sample quiz. I'll share my screen and show you, because we haven't taken quizzes. So some of you may not have had that experience in Brightspace. Others of you maybe do it all the time in other classes, but we have not done it in this class so far. So I want to make sure that you're not surprised by the format when you get into it.
Are we going to have a review for that?
Yes, we will.
Okay, thank you.
So we will go back and talk about the various things that we've discussed. In fact, that Tuesday, 2 weeks from today, that's what our class will be. So, all right. Any other things about the second draft or the final draft of your accounting principles explanation, the one that you need to share with somebody and get feedback on, is still, you still have a little time. It's not due till next Monday, but it is coming up. So in your groups or however you've decided you wanted to exchange papers, just a quick reminder that is upcoming, and that you want to submit not only your final draft, but some way of me seeing what the comments were from someone else, We talked about perhaps a screenshot or whatever other method that might take in order to show me what their feedback was. All right. So we're going to jump into, I'm going to share my screen and jump into some PowerPoint slides because, and the concept we're going to talk about today perhaps is the most critical idea that we're going to learn this semester in terms of how accounting is done. So, and for that matter, some of the things that you're going to need to do for the final exam. So we'll preference that in case you were planning to take a nap or something this afternoon, and maybe I'll get you to stay awake. All right. So let me get this. All right. So we're going to talk about the accounting equation. That right there, right at the top, right the first line, review. Assets equal liabilities plus stockholders' equity. That is the accounting equation. That is the basic accounting equation. It's also the equation for the balance sheet, right? That's what you should have on your balance sheet. Assets, then liabilities, then stockholders' equity. 3 sections. And we break the assets into current and long-term. We break liabilities into current and long-term. But that is kind of when we start expanding the accounting equation to be more inclusive that way and give us a little more detail. Now, how does that relate to that next line? Revenues minus expenses, right? That's our income statement formula. Revenues minus expenses plus or minus gains and losses. We add gains, we subtract losses. And remember, those are more unusual items, and so we don't expect a lot of gains and losses. All right, equal net income. That's the formula for the income statement, which is related back to our original accounting equation, because each one of those, revenues, expenses, gains and losses, change retained earnings, right? Because they would affect net income. If you have more revenues, like we talked about in our discussion posting, if we have more revenues, then our net income is going to increase, assuming that everything else stayed the same. And if that net income changes or goes up or whatever, then retained earnings is going to go up. It's going to go in the same direction as net income. And retained earnings is part of stockholders' equity, which means stockholders' equity is going to change or increase or decrease, whichever we're talking about. Okay, so all of those in that second line feed up into our stockholders' equity. A change in any one of those also changes stockholders' equity. So with that in mind, with that kind of construct, with that idea, we need to talk about the idea of what an account is. Accounts are simply something we want to track. If we want to track a particular asset, if we want to track a particular liability or expense, we set up an account for that. Okay, you can think of a lot of different illustrations of it. Buckets. I don't know if anybody ever saw somebody do their budget by taking all their money, convert all their money for the month, convert it into cash and put it in envelopes they need to spend it for. That's kind of setting up an account, is putting that money in that envelope as an account, because that's how you track how much you spent and how much you still have left to spend. Okay, so that's anything we want to track, then we set up an account. And so a chart of accounts is simply a list of all the items, assets, liabilities, revenues, etc., that we want to track the changes to. and report on the financial statement. So we're not going to be able to report in accounting on the financial statements unless we have an account set up for that. So if we want detail, if we want each asset to be separate on the balance sheet, then it must be separate in our chart of accounts. So if we want to track building, well, let's say our business owns 2 buildings. So one company might say, oh, we're just going to have one account and call it buildings, and they're both going to be in that account. We'll track them together. Someone else might say, no, I want those separate on the balance sheet. I want an account for building on the east side of town, and I want an account for the one on the west side of town. All right, so that's what is established by setting up our chart of accounts. We may have one account for at the bank. We might have 2 accounts at different banks. Each of those would then be an account on that chart of accounts and listed. All right, so FASB does not tell us how many accounts to have. There is no rules. There is nothing that says you have to have these accounts on your chart of accounts. So it really is a decision by the company and its accountants. Some companies want to be very, very detailed. They're going to have hundreds of accounts because they're tracking lots and lots of little detail. Especially, like for instance, even Hack has hundreds and hundreds of accounts because we receive money from various government entities that we have to spend in a very specific way. And so we have to have that account show that specificity. We can't just say, oh, it was spent for salaries. It has to be salaries for a particular department in a particular way. So we have to have an account for that. Otherwise, there's no way to track it and report back to the people that gave us the money. So colleges, any governmental entity is going to have hundreds and hundreds of very complex chart of account. And other companies can get by with maybe 20 or 25 accounts and be just fine because their business is relatively straightforward. It's relatively simple, okay? And they do the same thing lots of times, and so it doesn't need to have a lot of detail. All right, we talked about individual assets versus a group of assets. Whether you do buildings separate from equipment or you do it all in the same account, okay? If you have vehicles, trucks, cars, or you do it, all in one. But what we want to do to make our life easier is when we have this list, we're going to list assets together with assets and liabilities with other liabilities and expenses with other expenses. Otherwise, it gets really kind of confusing to do our accounting work. All right, so that helps us make our life a little easier if we'll just keep it together. So there's no real, this is how you have to do it. And even that last thing about keeping them together is simply for convenience. There is no FASB rule. There is no SEC requirement that says you must keep them together. No one is going to come and get after you for not doing that. It's just going to make your life harder. So here's an example of what a chart of account. They're very simple. This is a pretty simple chart of accounts. Notice the numbers. That's often how the computer remembers, right? Because this is all in real life. This is all done on the computer. And it becomes very important to make sure the computer can determine which account it is. And one of the nice things about numbers is you don't have to worry about spelling or whether or not that you used a different word or whatever. You tell the computer the number and it knows what the account is. And so most of the time when you see a chart of accounts, it will list numbers and some type of a description. And notice assets are together in numbering and just in a section, and then they actually have like a heading. Now that's a little unusual. That's to be extra helpful to you to look at. Most of the time when you see a chart of accounts, it's not going to have those separate headings. It's just going to have assets, then liabilities. And this is usually the order: assets, then liabilities, stockholders' equity, revenue, expenses, other go last. Okay. And so you would probably have gains or losses as an account down here under other as well, even though it's not shown here. It would be where that would typically fall. All right, this is a lot of information on this slide. Of course, you have access to it on Brightspace to go back and review. But these are some general rules so that we get even better at naming our accounts and knowing where to put them, because it's become even more important now to be able to determine whether an account is an asset, a liability, a revenue, expense, so that we know where to put it on the chart of accounts, and then of course where it goes on the financial statements later on when we've actually done some accounting. So some principles or notes to make note of in your head. If it says receivable, then it is an asset. So it's referring to the idea that we're going to receive in the future a future benefit, and that's our definition of an asset. Payable is going to let us know that it's a liability. So I gave you some examples. It means we owe, it means we have something to pay. Prepaid, and this was our number one error on the midterm exam, was putting prepaid expenses on our income statement. Prepaid, which means we have paid for something now and receive in the future, is an asset. Whatever is prepaid is teamed up with, it is an asset. So when the concept of being prepaid indicates a future benefit. Unearned, just the opposite. It is a liability. Indicates a liability. We receive cash and haven't done anything for it, so it's unearned. Now, a term you'll come across is accrued. All right. Anything that says accrued probably belongs with liabilities. The term accrued wages is the same as wages payable. So accrued means owed. In your textbook, it talks about the term grow is actually a situation where it's growing how much you owe, but the better thing to think about is that it's owed, so that you remember it's a liability. If you see the term earned, that almost always goes with revenues. Okay. And then the last term that you might run across is the term deferred, which means it's something later. So depending on what it's with, it could be unearned. Deferred revenue is the same as unearned revenue. It could also be a deferred asset because payments are going to be received later. So you're going to have to look for more clues. So deferred is a little tricky. Okay, it means something in the future. And you're going to need some other words. You're going to have to look at what it's with to know whether it's an asset or a liability. All right, so there's no way to give you a complete list of accounts. Businesses cannot, never will be able to identify all the things they might want to track. So these are some principles that will help you identify, use the terminology correct, put it in the right place on the financial statements, and all the other things that you need to do with that information. All right. So this, my friends, is the expanded accounting equation in a worksheet format. This is what we're going to use today to do to account or track changes in these items. So notice that we've expanded this in a way that instead of just assets equal liabilities plus stockholders' equity, we've put current and long-term under assets. That's not a big deal. We've put current and long-term under liabilities. We've broken stockholders' equity into capital stock and retained earnings. We know that those two are part of stockholders' equity. And then we've indicated what we talked about earlier, that revenues, expenses, gains and losses, and behind pictures, dividends are all part of retained earnings. And I have put the plus here because in revenues increase retained earnings. The minus expenses decrease retained earnings. Gains increase, losses decrease, and dividends decrease. So you got all of these columns that affect retained earnings. Now, this can be used even further to subdivide current assets into multiple columns. So if you think of this as like a big generic column, and it has smaller columns down here for each of your accounts. So here's where you would put cash, accounts receivable, inventory. They would each be their own column because we need to track increases and decreases for each one of those assets. Same thing for, say, long-term liabilities. We could have a loan payable, and if somebody else decided, some other company might have multiple loans payable that they want to keep separate, and they would have an account or a column under long-term liabilities for each of those loans. We could have as many expenses as we wanted to keep track of, different expenses, as columns underneath expenses. And in those columns, we're going to put increases or decreases. So we're going to use just regular numbers for increases, and we're going to use minuses, all right, or parentheses as decreases for it to go down. Now, when something is the opposite, when it has a minus sign in front of it, like expenses, we're going to do it with a minus being the increase, okay? All right, so when we have increase in expenses, we're going to use a minus. When we have increase in losses, we're going to have a minus. And when we increase dividends, we're going to have a minus. Everything else is going to work with the positive number being increase and negative number being decrease or in parentheses. So that's how we start to actually take what's happening in the business events, and we put them in this accounting equation. Now, the key is we have to keep it equal. So if we change anything on this side, we have to change something on this side. For every action, there's an equal and opposite reaction. We have to have two things. Now, we could have one asset change into another asset, and that would only affect the current asset, the two asset columns. It would not change the total, and therefore would not need to affect these others. But if this total changes, then these something on this side must change. And the same thing goes the other way. If something on this side changes in total, then something on this side has to change because there has to stay equal. That's the requirement. Other than that, you can put as many columns as you want, as long as you can keep it equal when you make the changes. So, believe it or not, even though there are hundreds and thousands of different ways that things can happen in a business, events that can happen, things that change actual accounts are actually somewhat limited. And the reason why is because the equation has to stay balanced. It has to stay equal. So when you're thinking about assets, the only way you can have assets change is, number one, exchange one asset for another. So if you pay cash for a building, if you pay cash for anything, any asset that is, then you've exchanged one asset for another. So that changes the assets. Now that one doesn't change the total assets. It just moves it from one asset to another. If you buy prepaid insurance with cash, if you buy supplies with cash, all of those are examples of exchanging one asset for another. So that's one possibility. So when you're thinking about the change of what you think, okay, that's what's happening. We're exchanging one asset for another. It changes the amounts within the assets, but does not change the overall total assets. All right. We attain an asset. Number two, we can obtain an asset by incurring a liability, borrowing money, leasing equipment. We go down to the equipment dealer and we sign a 5-year lease. Take the equipment home. We have the equipment asset and we have that liability that we have to pay. And they're the same amount in that example. Okay? So the asset is going to go up and liability is going to go up in this situation. If you borrow money from the bank, they're going to put cash in your account. That's going to make the cash asset go up. But you're also going to have to pay it back. So you have a liability under long-term liabilities or short-term liabilities, depending on what the agreement is as to when you have to pay it. Number three, you can get assets from your shareholders, or you can give assets to the shareholders. So to or from shareholders. So if you sell stock to your shareholders, they give you cash, you give them the shares of the company. So you're going to have an increase in assets and an increase in capital stock. When you pay them dividends, you're going to decrease assets, okay, and decrease retained earnings by paying dividends. So those are the first three. Then fourth, you can earn more assets by doing something, providing goods or services, which we know is the way we earn revenues. We'll talk a little bit more about that in just a minute. So that's the only way you can change assets. Okay, so it's a limited list. It's not as complicated. Now, you can have hundreds of examples of each of those four, but they all fall under those four pieces. All right. So I'm trying to help you narrow it down so that it doesn't seem quite so overwhelming about all the different changes. All the changes, assets, really come down to these four. Now, how about liabilities on the other side? So, same thing, there's a limit. you can incur a liability to obtain an asset. Now, that really is the opposite side of this one, right? We already talked about that. So that we're already discussed. This is the other side of that. We can increase liabilities by getting an asset by borrowing that money. But we don't want to forget the payoff, okay, of that liability. When we pay that back, that is going to change the liabilities and the assets, okay? Now, the trickier one of this three, okay, is incurring expenses that will be paid later. So our employees, and we've discussed this a little bit before, employees work for us. We don't pay them immediately as they work. So what happens is that they are working and should be recording that we owe them the money. That's an expense. Their time, their work is an expense, and we have a liability. So that's a way to change the liability account by incurring an expense. All right. Now, when you pay that, it's back up to this same concept. We're paying back the amount that's owed. But utilizing those expenses like utilities, wages, interest, any of those is an expense that's happening, but we're going to have to pay it later. That's going to become a liability. And then if we receive cash or some other asset, for that matter, for goods or services to be provided later, we receive the money now, but we haven't done anything yet. That's unearned. That's a liability. We owe the customer something. We've discussed that previously, but that's the third way that we can generate a liability. So, and have it be put into our accounting equation. So there is a limit to what is involved here in terms of what you have to think through. So we've done assets, we've done changes in liabilities. Now, how do we know when we have a revenue? How do we know that we have earned something and that we can record under the revenue recognition principle way back from chapter 2, all right, that we can put it on our income statement and increase retained earnings, because that's what happens when revenues are recognized. So there is a 5-step process. This actually does come from the FASB. This is United States GAAP. These is the guidance on how to know when you've found a revenue. First of all, there must be a contract. It doesn't have to be in writing, although it's encouraged to be so, between a customer and the company. There has to be an agreement. That seems kind of obvious, but companies have been known to simply ship things to people, all right, and expect them to get, respond by paying them and counting that as revenue. The point is, you shipped it to them without any contract, without any agreement ahead of time that that's what you wanted. Okay. And it doesn't happen very often, but it has happened. And companies can't count that as revenue. So there has to be a contract. We have to know what that contract is. We have to be able to see what the terms of the contract. It could be a handshake, but it still needs to be an agreement. That agreement then tells us what the performance obligation, that agreement says what has to be done in this contract. We're the company, we have an agreement with you, the customer. What does that agreement say I have to do for you? What am I agreeing to provide to you? Is it goods? Is it services? Is it a combination? Is there multiple things I'm promising to do? Am I building you a house? Am I, whatever. We identify what it is that we are obligated to provide. Then in that contract, there should also be the most likely contract price we have to determine. And that means we have to adjust for any discounts we offer for buying a lot of stuff or paying early or any of the things that we may offer discounts for. Okay. So that all has to be part of that contract price because discounts are likely to be taken. So we need to, if we're selling, if the price is $100, but it's very likely that we will pay early and only pay 98, then 98 is the contract, should be the contract price. So we go back to step 2, the performance obligations for step number 4, because we have to allocate what we got in step number 3 to the performance obligations and we got in step number 2. So let's say in step number 2, we identify that we were doing 2 things for our customer. That the contract stated we were providing them with a new computer system, a big one, and we were installing it. We were we were selling them a computer, but we're also installing it and the software and providing support for the next year. So there's more than one performance obligation. And we have to take the price that we determined number 3 and allocate it between those. So if we determine that there's the computer and there's the installation and support, then we have to take that contract price and say how much of it is for each one. All right. And that's a fairly involved process that we're not going to get into the detail of, but you should know that it can be important to know what each of those performance obligations is worth, if you will. Then we recognize the revenue as we complete the performance obligations. So if we say, let's say that the total contract price was $100 million, and we say that 80 million of that was for the computer and 20 million of it was for installation and support, that's how we allocated it. Then when we deliver the computer, then we can recognize revenue for 80 million. And not until we have provided the support can we recognize revenue for the other 20 million. So that's why this is important, especially when there's more than one performance obligation. So this is just to give you an example of how this plays out in, say, when you go shopping at Walmart, something we can all relate to, perhaps. All right, when we go to the store at Walmart and we buy something, there's a understood contract between us and Walmart. And one of the things that's part of that contract is that I get to take home my thing, whatever I bought. But there's also an understood that I can bring it back if I don't like it. Right? I mean, that is kind of the underlying. We didn't sign anything. They didn't sign anything, but that has become the understood. And there's a whole bunch of laws about that idea, okay, that we're not going to get into, but that's an understood. So here's the thing about that revenue for the item. Walmart has to estimate what is most likely going to happen in terms of how many people are going to return that, because that is a part of the contract. And the price, the most likely scenario is that some of it's going to come back. Walmart has years and years and years of experience. They have computers filled with information about how often their customers bring stuff back. So with that, they say, all right, Mr. Nielsen bought $100 worth of stuff. On average, people bring back about 4% of our stuff. So we're going to recognize revenue not of 100, but of 96. We're going to take that estimated return off right up front. Now, I may not bring that back, but in general, they're looking at that as an estimate. So even a simple thing as shopping at Walmart with only one performance obligation, a very simple contract, still has an issue that we need to look at this process and determine how much revenue to recognize. So we've done assets, liabilities, revenue, now expenses. How do we know we have expenses? Well, the definition is they're the cost to earn revenue. So the most obvious is we match the expenses to the revenues as they are earned. That's what cost of goods sold is. Cost of goods sold is the cost of the items we sold when we earned the revenue recorded. So when Harley Davidson sells a motorcycle in June, it wants to have cost of goods sold for the cost of making that same motorcycle recorded in June to match up against the sales or revenue for June of that motorcycle. That's what we mean by matching. That is the most straightforward of the expense concepts. It sounds pretty straightforward. It's a little more complicated in real life because we're doing it hundreds and hundreds, maybe thousands of different times in a month. Okay, so it does get a little bit more complicated than I may just made it sound, but the concept is straightforward. Okay, I built that Harley motorcycle for $15,000. I sold it for $25,000. I want to be able to see that difference on my income statement with the revenues, including the $25,000 and the cost of goods sold, including the $15,000. All right. So other expenses aren't quite so direct. I mean, we can clearly see that you have to have motorcycles and they have a cost before you can sell them. But you have a whole bunch of other things like utilities and rent and all kinds of other things where you have used and the benefit that is in the past. It's either benefiting the company right now or it's in the past. That makes it an expense. So it's a resource that's been used or is currently being used. And even in assets that last a long time, like a piece of equipment, we are going to use it up over time. And the used up asset becomes an expense. When we use our prepaid insurance over time, it becomes an expense. So a future benefit becomes the past benefit as time goes by, just because time happened. All right. And we use the building or the equipment. And then the last one is that there is just a reduction in a future benefit. Something happened, not as we expected, but the asset doesn't have the future benefit we thought, okay? And therefore, it needs to become an expense instead of an asset. So that's the ways you can have expenses. Again, limited, not a. Now you can have examples under each one of those, but the list is fairly limited. All right. Any questions about what we just went over? Because we're going to do a worksheet and we're going to together. But before we do that, I want to do some polling questions, the review, and make sure we're getting these ideas in our head correctly. All right. So I've got some questions here. So as they come up, then you choose one answer and then we'll discuss it a little bit. So your first question should be up. All right, everybody's voted. All right, and we got the right answer. 5 steps to determine revenue. All right, 5-step process. All right. So there we go. There's the share, the results. Okay, next question. Which of the following is not a way for a company to increase assets? Couple more votes. Okay, everybody's voted. All right. So notice this was, again, this was not a way for a company to increase assets. Borrowing cash from the bank would increase our assets. Your assets would increase, your cash, right? And the note payable or the loan under liabilities would also increase. So pay off a loan is the correct answer, because if you're paying off a loan, what's happening to your assets? They're actually going down because you're giving the cash back to the bank or to whoever loaned it to you in the first place. So the assets are going down, as are the liabilities. So that is the correct answer as far as not a way for a company to increase. All the other ones would increase our assets.
Which one was the correct answer again?
A, or pay off a loan using cash.
Okay. Thank you.
Sure. Okay. Number 3, just a true false. Couple more votes. Okay. Sharing the results. Vast majority had the right answer. There is no set requirement. There are not a set number of accounts under US GAAP. Each company can choose their chart of accounts, set it up the way they want to. So there's no need to have a particularly set amount of accounts in our chart of accounts. All right. Question number 4. In the expanded accounting equation worksheet, which of the following happens when expenses increase? Okay, a couple more answers. All right. Here's our results. So when in our accounting equation on the right-hand side, if expenses increase, that means stockholders' equity decreases. Having expenses increase does not necessarily impact revenues. Revenues are for earning things, right? We earn our revenues by providing services, goods or services. And so we would generally expect that if we're increasing our expenses, that the revenues are also increasing as well, but that's not necessarily caused by the expenses increasing in terms of the accounting equation. So the correct answer is B, stockholders' equity decreases, and liabilities would have to increase to keep our accounting equation in balance, and assets would have to actually decrease if we were thinking about the total accounting equation. All right, number 5. The account name deferred revenue is going to be found where? Which of these 4 sections in the chart of accounts or whatever, however you want to think of it on the financial statements? A few more votes. All right. So we got the right answer. Liabilities. Deferred revenue is the same as unearned revenue. Deferred means postponed, some other in it later. And that's what it's describing. This revenue will be earned later. And so therefore we owe or have a liability to our customer to provide whatever the goods or services that we agreed to provide when they paid us. Okay, so deferred revenue would be a liability. All right. Where does the account called trade receivables belong on the chart of accounts? Similar to the last one. A few more votes. All right. All right. Overwhelmingly, we got the right answer. Current assets. Receivable indicates asset. Future benefit that's going to be received, right? So it's receivable. It may be associated with revenue, but it is the receivable is the asset that you're going to receive. All right. Last polling question. Prepaid subscriptions will be found on which of the financial statements? So this is not asking you where it goes on the chart of accounts, where it goes on the financial statements. Okay, a couple more votes. All right. So the majority of us got the correct answer. Okay. Prepaid indicates an asset. Prepaid subscriptions would be an asset. And assets belong on the balance sheet. Revenues and expenses belong on the income statement, but not assets. So anything with a prepaid in front is going to be an asset and belongs on the balance sheet. All right, so there's some things for you to go back and review. So let's go. We're going to go to our accounting worksheet. This is what you're going to need to do for your homework. I'm going to share a Excel spreadsheet. Now, I put the yellow lines in here just to make it easier to follow. That is not necessarily a requirement. You can do this in Google Sheets. You can do this in any form you'd like. You probably can even do this if you set up a table in Word, but it's a lot more, I think, frustrating in Word than it is in Excel. All right. So I have put across the top assets, liabilities, stockholders' equity, just like in our PowerPoint. I divided up assets in the current long-term, liabilities, current long-term, capital stock. We have retained earnings, we have revenues, and then we have expenses, and we have three columns here under expenses in case we have to do that. So none of the things have been identified. None of the columns we're going to use have been identified except for cash. You can promise that there will always be, in any company that's going to operate, there has to be cash. That is the one asset you know they have to have, okay, to start with. And I always put it in my first column under current assets. Now, what I have over here on this side is the actual transactions. Okay, this is what's going to happen at the company. These are the events. And then we're going to put them in the columns as we determine where the increases and decreases are. So, May 5th, we issued stock to shareholders for $50,000 in cash. So we know the amount, right? We know that cash is going to increase. So we're going to come over here and put 50,000 in cash. On the asset side, right? So we need a change on the other side, and we sold stock to them, so they become stockholders, and when they make an investment, that increases our capital stock by 50,000 as well. So we are in balance, right? Cash, assets went up, capital stock, stockholders' equity went up, no change to liabilities, and that's okay. Okay? We don't have to change everything. We just have to change it to the point where there's always going to be two things at least that are going to change, but just so it stays in balance. Okay, so we come back over here and we can see that the next thing that happens to this business, next business decision we make is to borrow money from the bank. Okay. And that is a way to make our assets change, right? That was one of on our list. Okay. So we're going to borrow and make cash go up another 27,000. And we're going to assume that this is a loan that's going to be paid back further than 1 year. So we're going to make a column here for, let's call it loan payable. All right, under the long-term liability column, we're going to have a loan payable, and we're going to put 27,000 increase there, right? Because we owe that money. Now, if you'll notice what's happening down here at the bottom, I have put formulas down here at the bottom to add the columns up automatically. All right. Now, you don't have to do that. You can do it after you're done or whatever, but it makes it really nice when you just have it recalculating as you go along. Excel doing the work for us. Okay. May 11th, we purchased $2,000 inventory on credit. Well, I don't have a column for inventory, but that is a current asset. So I'm going to add that in so that I can make inventory, that column, increase by 2,000. And I bought it on credit, which means I owe money for it. I haven't paid for it yet. I owe somebody, and we call that accounts payable. And that's going to increase 2,000 because we owe that. See, if liabilities went up, assets went up. We bought something on credit. All right, so that was on our list of ways that we change both assets and liabilities. Okay, now May 15th, we're going to purchase equipment with $1,000 in cash and borrowing the other 11,000. So the equipment must cost 12, right? We paid 1,000 down payment, if you will, and borrowed the rest from the bank. So we know that we paid 1,000. That's going to make our cash go down. We bought equipment, and we don't have a column for equipment yet, but we know it's a long-term asset. So we're going to put that equipment there, and we know that that total cost was 12,000. And now here's a decision we could make. Do we set up a separate account for a loan payable for this loan versus the one we did earlier? And it's up to you entirely. But to keep it a little more compact and not as confusing, I'm going to put it in the same place. If it's less, same column. If you choose to make it a separate column, that will never be an issue as long as it's in the right place. So in this case, it would be, now, let's see if we're in balance. The assets, we had an asset go down 1,000 and a different asset go up 12,000. So assets changed by 11. Liabilities changed by 11 as well. So we're in balance. We're good. All right. So any questions so far? Are we following this? We good? Okay. I'm hearing no concerns. So this is on the whole thing filled out is on this. Let me see, we might have something that it might take a little while to sink in. That's okay. You've got the actual PowerPoint slides with this all filled out. You can look at, stare at as long as you need to, okay? But it really does just come with some practice, okay? It just we need to practice it multiple times, and that's what their homework is going to be. You're going to do exactly the same thing with a set of, I'll give you these things, and you'll set up and do that, the same process, okay? So, May 20th, received cash of $1,500 from a customer for service to be provided in the next month. Sorry, I have to move over a little bit further there. Provided the next month. So we got cash, but we haven't done anything for it yet. So that is a liability called unearned revenue, right? We're going to put it on the current. Make it go up. And notice I'm also skipping a line in between each thing, and that's doesn't have to be the way it does either way. I think that just makes it a little easier to read and follow. Okay. And that was cash, right? Went up. So a liability went up and cash went up. So that was that business event. Oh.
Sorry, that was an accident.
Oh, okay. I was
Yeah.
it looked cool. Yeah.
I was confused too.
I'm like, hey, that's cool, but I'm not sure what he's telling me. But all right, okay, there we go.
There we go.
All right. Okay, on to the 21st. We're going to sell inventory to a customer for cash. So they come in and they're going to pay us cash for the inventory. The cost of that inventory is $1,500. So this is the most complicated of our transactions that we're going to do here, okay, in this spreadsheet. So there's two things that have to happen. We have to record the 4,000 and the 1,500. So the 4,000 is cash we received from the customer. So that went up. That's an increase. And because we sold them something, that must be a revenue. Okay, so we're in balance, right? Revenues makes stockholders' equity go up. Our assets went up. But the same, we had a second thing happen. We gave them some inventory. So our inventory has to go down. We're going to use a minus or a parentheses to indicate that inventory went down. And that's going to be the cost of goods sold expense. All right, now it goes up, but we know that expenses go kind of backwards, if you will. And so we're going to put it in as a minus. All right, and that will make our math work out. So we have recorded the 1,500 and the 4,000. We are in balance on both sides of the equation. All right, that one is the hardest one. Okay, 23rd, we got a bill from the electric company that for electricity we used during May to be paid in June. So we haven't paid it yet, so we can't record cash. We have to show that we owe it, and we have to show electricity. Well, electricity is an expense. So you could call it, again, it's another time you could make a decision about your account. Do you want it to be utilities and put all of your water and sewer and electric, or do you want it separated into electric expense and gas expense? I'm just going to put utilities, but again, there's no right answer on that or wrong answer. All right, and that's an expense, so it reduces our retained earnings, and we haven't paid it yet, so don't go over and use cash yet. That's the temptation there. And accounts payable is what we owe. Whenever we owe somebody for something they've sold to us, it's accounts payable. So this makes it go down. This is a negative. This is a positive, okay? Liability. So we're in balance. This side of the equation didn't change because we changed liabilities and equity. Both. All right. May 31st, we provided services to our customer. Customer B, that's the same customer as we got up here for, okay? It's 1,500. Oh, we actually need to change that name. I'll have to fix that. This is of the contract we did right up here. So we did some of the services for them early. So we have earned a revenue, at least part of it. So we've got revenue increased by 500 and unearned revenue decreased because no longer unearned, it's been earned. We've done what we promised to do, what was part of that contract. All right. So we did lots of things on May 31st. Paid for the inventory. So remember this inventory we bought back here where we owe 2,000, right? We're going to pay for that. So that means my cash is going to go down and my accounts payable is going to go down because we paid off our bill with cash. That means our accounting equation is still in balance, right? Because those are both on different sides of the equal sign. Then we paid some dividends, just for kicks. So we make dividends negative, and cash is going to go down because that's what happens when we pay dividends in cash. And we used up equipment. So this equipment that we bought here, okay, is going to get used up. 1 month's worth of it. Okay. So let's say that our equipment could be used for 5 years, and we used 1 month of it. So I'm going to do a little calculation here. 12,000 divided by 5 divided by 12. That's divided by years. That's 5 years. Divided by 12 is get 1 month. Okay. $200. All right. Nope. That needs to be reduction, right? Because it got used. It's no longer there. So I have to change my formula to minus. There we go. So I used up 200. I have 11,800 still left, right, to use. And then that would be, some of you have used the term depreciation before, but I'm just going to put it in other expense. It's actually depreciation is the correct term, but we haven't introduced that officially in this course yet. If you would choose to use depreciation, that's fine. If you just want to put it in other expenses, that's fine as well. So we have recorded each of our, what is that, 11 transactions. And Excel has calculated the totals at the bottom, or the ending at the bottom, as we went along. Okay? Now, to check ourselves and make sure that we didn't make a mistake along the way, this is the total 91,200 on the left side of the equal sign. This is your liabilities, and this is your owner's equity, which is a total of all of these. So they should, these two together should equal 91,200, right? So just to make sure, we're going to add those two together. And yes, it's 91,200 equals 91,200. The whole thing is in balance, which is exactly what we want to have happen. So we didn't just do all this for fun. This was actually a prelude to creating our financial statements for this time period. Now we started this, all these transactions happened in May. So we're doing the accounting period is May. So I would make my financial statements using the information from my worksheet. So my revenues come from this revenue column, right? My cost of goods sold comes from the cost of goods sold column. Now, when we put it on the income statement, we don't need to put the minuses because we know expenses are subtracted on the income statement. Then the utilities expense, other expense, we get net income. Always do it in this order, right? Income statement first, then the statement of equity. Now, for both capital stock and retained earnings, this was a brand new company, so it started with 0. We sold stock for $50,000, which is not being picked up in my formula. Okay, so I actually have formulas in these cells that refer to those other cells if you know how to do that. Otherwise, you can just type in the numbers. So 2 columns, capital stock, retained earnings, okay? Going on to the balance sheet. income statement, statement of retained earnings, statement of equity, second. Don't go straight to the balance sheet till you've done the statement of equity. Our next most common mistake on our midterm exam. Assets come from the cash column, the inventory column, the equipment column. Total it. Accounts payable from the accounts payable column. 1,000 from the unearned revenue column. Loan payable from the loan payable column. Remember, we had those to get, there's two loans involved. We put them in the same column. You're free to have separate ones. That means you would have two separate loans on your balance sheet. Total liabilities. Capital stock comes from the statement of equity, as does the retained earnings. Comes over here and goes on the retained earnings on the balance sheet. The total is 51,470, and so total assets equal total liabilities and equity. All right, so there's the three main statements, but I think we can also do a cash flow. We know the beginning cash is 0, and what we're going to do is everything in the cash column is going to go into one of our three buckets. So as we look at this column, only this column, just kind of for a minute, we're just going to ignore everything else. We're only going to look at the cash column. The first thing in this cash column is $50,000 from the sale of stock. Okay. So from the sale of stock, we got $50,000 cash from the stockholders. That's a plus, right? That was an increase in cash. The next cash transaction is $27,000 from the bank. That also goes under financing. Borrowing money, anything to do with shareholders, has to do is in the financing bucket. It was a positive number. Okay, because it was cash coming in. All right. Then that's the next thing we received. Well, the next thing we didn't receive, we paid $1,000 on our equipment. Well, equipment goes into investing. Any long-term assets, anything you have to do with long-term assets go there. And this is money going out, so we have to put a negative there. Cash paid for equipment. And then we got $1,500 and $4,000. Both of these are from customers. Okay. So we can separate that into the cash from sales and the cash from the customer separated, or you could have put them literally together under cash for customer. You paid, that's an operating, because that's normal part of our business, everyday kind of thing. Paying for accounts payable. The next one on this is where we're paying our bills. So it's cash going out. And then finally dividends, cash going out. So it's a negative. So we had $3,500 cash from operating, $1,000 negative cash for investing, and $76,400 total cash from financing. Add those three up, and that's our changing cash. Since we started with 0, that's also our ending cash. And look, that's our ending cash. Exactly the same as there on our balance sheet and our ending cash on the cash flow. So we know we got everything taken care of on the cash flow. So that's the process. Each of the transactions, total up the columns, put the columns on the financial statements based on where they belong. Why it's so important to have it on the chart of accounts correctly, because it makes it so much easier If assets are together with assets, liabilities are with liabilities, you just put it on the balance sheet all at once. If you have to keep jumping around where it goes, it becomes difficult. And then the cash flow is only one column, and that's the first column, at least if you put cash in the first column like I did. Which again, it's not a requirement, but I'm just telling you, there's always cash, and I always find that it's easiest if you just put it on the first column. Now, when you're done for the month of May, which is when this business started. So this was a brand new business, so there was nothing coming from the month before. In April, everything was zeros. But when you go forward and do June, okay, you're going to have to start with what you ended with in May. For all of these items, assets, liabilities, capital stock, and when you go to the next month or next accounting period, you're going to have a column for retained earnings to bring over what you had from the month before. So when you start June, you would start with cash of 78,900, inventory of 500, equipment 11,800. And then you would have all the changes in June in those columns. But you're going to have at the top of the column a place for what you have from the month before. Accounts payable, unearned revenue, loan payable, $50,000 in capital stock. And then you would have retained earnings of 1,470 from May. Then what you're going to do is for revenues and expenses, they don't come forward. So when you do June, you're going to start with zero revenue because you want to measure how much revenue we earn in June. So you start over at zero for revenues and expenses and dividends. Everything else, the end of May becomes the beginning of June. And that's kind of important when because obviously in real life, you don't just do this for 1 month, you do this for accounting period over and over again. And I'm going to ask you to do that for your homework for Thursday. Okay. Now I'll give you a little warning for the homework. When you set it up and do it, you're actually going to end up with negative net income. All right. Don't let that concern you. Everything works exactly the same. If that's a negative, meaning the expenses are going to be higher than the revenues, that's not unusual for a new company. And so don't think you've messed it up royally when that ends up being negative. I know a lot of places and textbooks and stuff that you never see anything negative, but we set it up that way. So just don't worry about it. Know that, and if you do get a positive net income, then you know that you probably made a mistake somewhere along the line. Okay. All right. Let's go back to, I can see everybody. So questions, concerns. So that's the key. That's the crux of what we need to learn. So I am going to let you go as far as today. I will stick around as usual and see if there's any additional questions any of you have. that you want to ask. But if you do not or good, then I suggest you get started on that homework as soon as possible while it's still fresh in your mind as we've gone over it, because that's a good way to reinforce what you just saw, is to do it yourself and to do it reasonably soon. The longer you wait, and the harder it's going to be to remember. But there we go. So otherwise, then that's what we will review, similar to like we just did there, the answer to the homework on Thursday, and you'll be able to make any corrections you need to, as usual. All right, so that's where we are. I'll stick around. Otherwise, I will see you on Thursday.
Thank you.
You're welcome.
Thank you.
Thank you. Have a good one.
Or you too.
Thanks. Have a good day.
Take care.
I had a quick question. So
Sure.
we have to make that chart and then the bottom stuff, right? For the homework?
Yep.
Is that it? Or do we have to do like the chapter 5, problem 1, 2 review? I mean, research.
Oh, there's no research assigned this time. Those you could do that for extra, but that's not the assignment. The assignment is to do just the problems, and it's all that process I just showed you.
Okay.
Okay.
All right. Thank you.
Sure.